In this example video, we're going to be looking at putting together a bank reconciliation and the necessary journal entries. When we're thinking about a bank reconciliation, what we're looking at is the company's ledger for cash and comparing that to the bank statement at the end of the month that the company receives. So we're always doing a bank reconciliation as of the last day of the month, and we're looking for differences. And basically whatever side, meaning the cash company side or the statement from the bank, whatever side didn't know about the transaction or the reconciling item is the side we're going to adjust for. The only time that does not happen is when someone has made a mistake. So if the company makes an error, we're going to adjust the company side. If the bank makes a mistake, we're going to adjust the bank side. And when we get into journal entries, the only thing that we have to journalize are any adjustments that we made to the company section of our bank reconciliation. We do not have to do any adjustments to our company's books for any reconciling item that affected the bank side. Those are things that we as the company already knew about, we have properly recorded, and that the bank just either doesn't know about or needs to fix. So let's take a look at our example here. It says the following data were accumulated for use in reconciling the bank account of Creative Design Company for August 20Y6. So they tell us that the cash balance according to the company's records, again, as of the last day of the month, that's what we're always looking at, is $20,870. The cash balance according to the bank statement at August 31st is $37,600. And then they tell us about some reconciling items. This is a wonderful internal control because the bank is just simply recording where the cash is coming from and going. It doesn't care who's supposed to have access to it or not. So it's a nice internal control for the company to do this reconciliation at the end of every month. So they tell us that there is checks outstanding in the amount of $23,375. When we're talking about outstanding checks, those are checks that the company has written, the company has journalized, and the company has sent out to those that they owed that money to. However, the people that or the businesses they've sent the money to just simply have not cashed those checks yet. So the bank, therefore, is unaware that those checks have even been written. So that's going to be an adjustment to the bank side of our reconciliation, because the minute that supplier or that vendor cashes the check that I sent to them, my cash balance is going to go down. So with outstanding checks, the bank doesn't know that that $23,375 does not belong to me. They also tell us that there's a deposit in transit that was not recorded by the bank of $7,500. So if I, at the end of my business day at 8 o'clock at night, stop on my way home at the ATM to deposit some of the cash that we received that day, let's say $7,500, I know that I have that cash. I did the journal entry before I ever left the business at 8 o'clock at night, and I deposit it through the ATM. The bank doesn't know about that until it has actually processed that money. So whether it was cash or checks, it might take a day or two. So if I make that deposit on August 31st, there's no way that it's going to appear on my August 31st bank statement because it takes a day or so to process. So it's money that we as the company knew about, we have properly recorded in our cash ledger, but the bank doesn't know about it yet. So that is again going to be an adjustment on the bank side of our reconciliation, and it's going to increase by $7,500. Again, think about how checks and deposits affect your bank account. You know that when you make a deposit, you have more money. So deposits in transit, we're going to add on the bank side. You know that when you write a check to somebody and they cash it, it reduces your cash balance. So that's going to be a deduction on that bank side. It then tells us that a check for $100 in payment of an account was erroneously recorded in the check register as $1,000. So this is a mistake that we as the company has made. So the check register is ours. So instead of putting 100, we put in 1,000. So we need to adjust our cash ledger for that incorrect amount. So we're going to make that adjustment on the company side. And then it tells us that there was a bank debit memo for service charges of $45. So when we open up our bank statement and we review it, we see that the bank charged us $45 in terms of fees. So that could be using another ATM. Maybe we had a bounced check fee. Maybe we ordered more checks. Whatever the case may be, they're charging us $45 for it. The bank doesn't call me every time they charge me a fee, so I don't know about that fee and I don't record that fee until I see it on my bank statement. So since the bank knew about it, but the company did not, we're going to adjust the company side of our reconciliation for that service charge. And it's going to reduce our cash that we have in our ledger. Don't get confused by seeing that it was a debit memo. Remember, it was a bank debit memo, meaning that the bank debited our account. Remember, when the bank looks at us, they look at us as a liability. So a debit means that it's reducing their liability to us, meaning they owe us less money in the future because they've used some of that money, that $45. So now that we know all of our reconciling items and how they're going to affect us, let's get into actually putting together our reconciliation. So our reconciliation has a title, it has the company name, it says what it is, which in this case, again, is a bank reconciliation, and the date. Again, don't forget that your reconciliations are always done as of the last day of the month. We're never going to start with a beginning balance for the month, only the ending balance. So we have two sections. We have our company section and our bank section. So let's start with our company section. So we have our cash balance according to the bank statement. And we have a subtotal and a total column. So this is going to go into our total column. So the bank statement says that we currently have $37,600, but we know we have some reconciling items that we have to take a look at. So we have adjustments. So if we have any positive adjustments, we'll list those first, followed by anything that's going to negatively affect that balance. So we know we have that deposit in transit. So it's on its way of getting to us. It's just not there yet in my account. And that's for $7,500. We also know that there was outstanding checks. Checks that we as the company have written but just have not been cashed yet. And that reduces our bank balance by $23,375. So we're going to single underline this here. So we're going to net these two numbers out to get our total adjustments. So in total, we have to adjust our bank statement balance down by $15,875. So that gets us our adjusted balance. So our adjusted bank statement balance then is $21,725. And we are going to double underline that because we're not going to do anything else to that number. We have adjusted it as much as we're going to adjust it in terms of the bank statement balance. So now we have to look at the company side. So we have our cash balance according to our company's records. And they said that we had $20,870 sitting in our cash ledger at the end of August. So we have some adjustments that we have to look at. So again, anything that would have positively affected our account, we're going to list first before anything that negatively affected it. They told us that we had by accident recorded a payment of $100 as $1,000 in our check register. So we actually should increase our account by $900. The difference between the error amount of 1,000 and the correct amount of 100. So we're going to add that in. So we have an error in the recording, a check as 1,000 instead of 100. So In this case, the error worked in our favor. We actually had more money than we had anticipated. If the reverse was true, if we had only recorded that check that we paid out as $100 and it was $1,000, then we wouldn't subtract away $900. But again, the error kind of works in our favor here. And then we also had a bank service fee. And we know that bank service fee is going to reduce our cash value. So we're going to net this out to get our total adjustments. So overall, we're actually going to increase our cash value in our ledger by $855. So our adjusted balance should equal what we have as an adjusted balance for our bank, and it does. And again, we're going to double underline this because we are done with that section of our bank reconciliation. So right now in our ledger for cash, it says $20,870. But we now know by doing our reconciliation that that number is not correct. The correct value of cash that we should be reporting on our financial statements at the end of August is $21,725. So we need to journalize the two adjustments that happened, or two reconciling items that we had, only that affected the company side. Remember, we've already recorded that deposit in transit. We've already recorded the outstanding checks. The bank just hasn't had the chance to record those items yet. So we only need to record the items that are going to affect us as the company. So we have to journalize the error that we had for $900, and we have to journalize our bank service charge. So on August 31st, we're going to have some adjusting entries that we're going to have to do. First, my cash went up. We know my cash went up by $900. When you're doing your journal entries for bank reconciliation, one of the two accounts has to be cash because, again, that's what we're looking at. That's what we're looking to adjust. And they said the error was for a payment that we made on account. So that means that we improperly affected our accounts payable by $900. So we have to credit that account by $900. Also, on August 31st, we had to pay a bank service charge. So we put that in as a miscellaneous expense that we have. It's not big enough or frequent enough to give it its own account in our chart of accounts. So it's going to fall into that miscellaneous account of $45. And again, one of the two accounts in every one of these transactions is going to be cash. Is it adding cash on our reconciliation, then it's a debit to our cash. If it's subtracting cash on our bank reconciliation, then it's a credit.